Joining me now in studio is Jordan Toy from Legacy Family Wealth to give us his take on the latest movements in the markets. Jordan, thanks so much for coming into studio yet again. Now we have the first full week of trade for the month of August, and markets seem to be staging a recovery after that downbeat non-farm payrolls that were out on Friday. What's driving the optimism though? I mean, I mentioned at the top, there seems to be some fresh optimism around Fed rate cuts in September on the back of that print. Is it just that? Are we seeing some optimism coming through from earnings as well?
Certainly. So I think that there's a combination of factors, as usual with investment markets. It's difficult to pinpoint it down to one or two things. So I definitely think US earnings season as a whole, which has been driving a lot of global market moves, has gone relatively well. I think north of 80% of S&P 500 companies have beaten analyst expectations.
Yeah.
So we're seeing decent results out of the US and forward guidance on the whole being relatively decent. Then we obviously, as you mentioned, had the sort of labour market scare towards the end of last week, which was actually shaping up to be a pretty good week up until that point. And look, with the market, especially the US market at the levels that we're currently seeing it, any small sort of wobbles or nervousness that come in, you can see sort of some bigger moves from markets. So yeah, US earnings carrying a lot of the weight for markets so far this year.
And sticking with earnings, we are seeing some of those earnings filtering through on the local front, kicking things off with the big banks, the financials. Nedbank out with numbers, delivering a 6% increase in profit. But what caught many investors' eyes was that the sale of its stake in EcoBank, a move that shifts its African strategy to now focus on SADC as well as East Africa. What did you make of the move and its overall performance? I mean, it's also warning that earnings could be in the lower digits moving forward.
Yeah, so we saw reasonable sort of low single-digit growth in net interest income, decent growth on non-interest revenue as well. The thing that stood out to me, I think, or one of the items that stood out to me was the reduction in impairments. So we had an improvement in their credit loss ratio. I think it was around 18% reduction in impairments, which is obviously quite a significant. We're not talking like low single digits here. That's quite a substantial move. Bringing their credit losses to sort of within the cycle, I think it's 60 basis points up to 1%, sort of in that range. On EcoBank, I think the interesting thing there for me is, I mean, Jason Quinn is, I still want to say, relatively new to the position. He hasn't been there an awful long amount of time. So he's obviously had some time to get to grips with the organization and now sort of taking the reins and saying, look, this is where we need to change strategy, change direction. And when we're clearly seeing that coming through today with that sale of the stake in EcoBank.
Really, really holding his own in that position, and making changes that I guess align with what he wants to push forward for Nedbank moving forward. Sticking with results, JSE out with numbers as well today. And it's lovely to see that equity markets are now boosting the JSE's bottom line. We are so used to hearing about, the JSE diversifying its income streams and that really boosting markets. HEPS up over 13%, that is. Yes, HEPS up over 13%. Your take on those numbers? And I'm sure that strong equity market still going to, filter through into those results moving forward, considering what we've been seeing on the JSE.
Yes, of course. And I mean, I'm glad you mentioned the diversified revenue streams, because I think in an environment where you're, not having a huge amount of new companies coming to market and listing, the JSE certainly needs, and probably for years now has been looking at, we can't just rely on sort of new market entrants. There needs to be exactly that diversified revenue stream. So pleasing to see that that's delivering for the JSE. But I think ultimately you can't hide from, in the long term, you need a somewhat thriving equity market, which means we can't, we need some listings as well as, there will be corporate actions and delistings and so on. But we definitely need to see new companies coming to market, because overall you want the JSE to have that liquidity, also for the investment industry and the pension fund industry to be able to enter and exit positions. So you want this sort of thriving ecosystem, and if you have that sort of flywheel starting to get that positive movement, you'll see the JSE likely do even better. But pleasing to see, despite all of these headwinds that have been well covered, that the JSE still delivered some good numbers there.
And you mentioned new listings, and I can't remember a time we had a brand new listing. Last year was a big year for the JSE, but it was a lot of unwinding from businesses. You look at your
Boxer.
Boxer, We Buy Cars. There hasn't been a brand new. I can't think of anything at the top of my head.
So that's the challenge, right? If you're running a large private business, what is the reason you're going to list your business? Well, you have easy access to capital, you can raise funds, but I think we've seen in the past the JSE not necessarily, and no fault to the JSE, but not being the best environment for these companies to raise money in. And there's a lot of cost that comes with being a listed entity. So from management teams' perspectives, you need those to be more in balance for it to make sense for the company to pay those ongoing costs. And we need to see that cycle sort of turn more in the positive direction. And I think then we will see, and it's inherently linked to all these other things, right? Economic growth, etc. Hopefully we're moving in the right direction now, though.
All right, let's get into a company listed on the JSE, Telkom, out with a trading update. The mobile unit continues to shine. We are seeing, data subscriptions increasing in Q1. The fiber unit also doing well. I was surprised to see that the share price was down. Are markets not impressed with those numbers?
Difficult one to read through. Could be a bit of profit taking. Hard to make a call on that. But I think, we saw sort of top line revenues largely flat, and then you had EBITDA up quite strongly relative to revenues, right?
Yeah.
So you look at that and go, all right, well, there's some good cost containment measures going on there. You mentioned the fiber and the mobile business. So the mobile business in terms of data subscriptions had some strong growth there, which was pleasing to see. And I mean, OpenServe continues to go from sort of strength to strength. I think a number in their announcement that sort of 51% of homes that they've passed are sort of revenue generating for them. So pleasing to see those two sides of the business. BCX continues to be a bit of a drag on the business as a whole, or the Telkom group as a whole. We saw revenues down there, EBITDA's down even further. So we need that turnaround to start getting some momentum. I mean, nothing happens overnight, but that's I would say the one sort of negative that stood out to me out of the update from Telkom.
All right, let's hit pause on the conversation. Before we get to your stock pick, let's take a moment to touch on what your industry peers are finding interesting.
The Agnelli family's holding company for the material asset is actually Ferrari, with the ticker race, and also Stellantis, which is largely Fiat and Chrysler, and some other interesting assets, Philips in health tech. So overall, it's been very volatile, partly because of the anticipated tariffs and the impact that would have on motor manufacturing, particularly exporting into the US. I think what's happened now is that has flown, and now we understand what the actual tariffs are. So in that volatility, the discount went to greater than 50% discount to its underlying NAV of those listed assets. So it's a really good entry point, and I think the companies can plan, the underlying companies can plan based on the known tariff environment and move up from here. So that's why we think it's a sort of double discount entry point into that sort of motor sector, and quite an opportune investment.
Exactly. They have a capital markets day at the end of the week, and generally these capital markets days are well received by investors, because the company gives you their long-term plans. They tell you what's really great about the company, and a lot of guys who are sitting on the fence, particularly from a long-term investment perspective, might decide to pull the trigger at that point. But that is not the only story here. The stock has been sold off in line with the rest of the retailers year to date, or over 1 year. I think we're down 30% for the clothing retailers in South Africa, even though we still continue to see pretty decent revenue growth and decent profitability as well. I think the outlook looks okay, but Foschini, I think, will probably benefit from some market share gains, the credit business, the new acquisitions that they have, the cross-selling opportunities between some of their operations from a credit rollout perspective. And I think that there's a lot to be positive about, and the share price is not reflecting that. I mean, leaders in local manufacturing when it comes to clothing, quick response, and the online platform also gaining traction quite nicely.
So Rowan, going with one I haven't heard of before, XOR, and then Chantal picking a local counter, TFG. Just your analysis on those stocks.
Yeah, so XOR, not the most widely known stock, but not one that I actively cover. Your guest mentioned sort of the strong portfolio of brands that they hold. I think one point to note is that it is family owned and controlled. So you have the family, with sort of north of 60% of the voting stake in that business. And then I think the one other risk to bear in mind, despite the discount to net asset value, is, it's largely auto sector investments that are held in that holding company. And I think that there's sort of still a lot of headwinds in the auto space, especially with the growth we're seeing out of China. So an interesting one, certainly. And then on TFG is a business I really like, right? So I think, as your guest, Chantal, I think it is correctly mentioned, it's down 30% year to date, so potentially a value entry point into that share. The part of the business that I really like is you have all these diversified or sort of different areas in retail, and the Bash offering or their online offering is something that brings all of that together. It's sort of one platform where you can go buy sort of furniture as well as sneakers, so it's quite a unique offering, I think, in that space. And one that continues to feature highly on our watch lists and portfolios.
So you like TFG, but that's not your stock pick. What are you hanging your hat on today?
So I wanted to talk about Palantir today. It's one I've talked about before, but I think it's very relevant considering that they came out with an earnings update yesterday in the US and really smashed it in this last quarter. I think revenues grew by sort of 48%, so exceptionally strong numbers out of Palantir. The expectations are exceptionally high because this company trades at sort of a 270 plus PE, depending on the day that you look at it at, sort of second only to Tesla in terms of S&P 500 companies, so a really rich multiple. But when you're delivering 50% revenue growth, arguably that you can go some way to justify that. I think the CEO came out with some what did he say? He said it was a crazy efficient revolution that they're looking at. So they are really one of the main beneficiaries of sort of monetizing AI, and they're talking about growing revenue 10 times while having actually less staff. So we'll see if they can deliver that. That's obviously a very ambitious target, but really, really strong numbers out of Palantir. I think everyone's sort of waiting to see when they actually do disappoint on the growth front. They haven't done so yet. I mean, they're signing, US government contracts are up 53%. I think they signed 60 plus deals over $5 million, sort of 20 plus deals over $10 million. I understand that they signed a US Army contract sort of around $10 billion. So they're making a lot of moves in that space. They're gaining US government revenues and obviously the US armed forces, the amount of spending that goes on in that space is massive. And I think when you look at the spending cuts that the Trump presidency has largely looked to do in the federal space, Palantir is a company that stands to benefit from that really well because they bring a lot of efficiencies into arguably inefficient government departments, defense, be it whatever it might be, and I think that they're really well positioned to continue to benefit from that, but a really rich valuation.
All right, let's leave it there. Jordan, thanks again for coming in. Lovely having you in studio. That was Jordan Toy from Legacy Family Wealth.